Good morning. Good morning. How's everybody? The 7 of you. It's a very small class today. I am going to get started. Remember to refresh your screen if it's blurry. I'll do my best to transmit in high resolution. So you should have seen your grades for the class. That's just a preliminary grade, and I based it on the test that you did. I had the TA grade the tests, and in looking through them, I made a few adjustments. I'm not quite done reviewing what he's done. So if you got a grade that you don't like, it might even go up. But I had to submit some preliminary grades, so that's what I sent based on what I saw and his grading as well. I sent you a bunch of documents. We're going to start the third module today. I sent the solutions for the last unit. I just need to turn off the sound for notifications. Let me see if I know how to do that. My new computer. How's the sound? How am I sounding? Okay, we have some more people who came in. Again, I don't like to have to send you the link. I'm hoping you'll use a playlist to find the link each week. And yeah, I don't know how to turn off the notifications, but okay. So these are the solutions. I'd asked you to work on these. I said I would send some answers, but I didn't. But you should have prepared your work, so now you can compare against the key, the clave. Okay, so this is the solution set here. Are there any problems you would like me to do before we get on to the new topic? Or you want to have a chance to look at it? I think we did quite a good treatment. It's just a matter of practice on your end to solve these problems. Yeah, we did this one together. So we did one of the longer problems together last time. Okay, so let me give you a few minutes to look through that. Let me know if there's any problems that you'd like me to do. Take 5 minutes to review the solutions and to open 3.1. Number 8. So Tanya suggested number 8. Let's look at that. Okay, so this is another one you have to read and make a timeline before you start. There's the answer. Okay, let's see. Let's cover the answer. All right. This company has been paying a dividend of $1.25 for several years. Its management plans to continue with the dividend for 2 more quarters and then to start increasing by 1% per quarter. With the first increase in the 3rd quarter of this year, the planned increase in dividends will be announced today. If the stock currently requires an 18% effective return per year, how much should its stock price increase when the company makes the announcement? All right, so this company has been paying $1.25 per quarter. So it's quarterly, the dividends are quarterly, so right off from the start, we need the quarterly effective rate to solve this problem, to make an evaluation of this stock given this data or this information. Its management plans to continue with this dividend for 2 more quarters and then to start increasing. So this dividend is going to be paid every quarter, so that would begin, let's say now, and then I'm going to make this in terms of quarters, so I'll make a note here, quarters. So that's Q1, or I'll just write 1. You have to remember it stands for quarters. Now by the 3rd quarter, growth kicks in. So G in here is 1%. Where the cash flows are $1.25 per dividend, per share. So someone could have invested in several shares, but each share earns $1.25 per quarter for the first 2 quarters, and then it grows. So this one will be like that. And then this goes on indefinitely. Now there was a dividend here as well, but as a prospective investor, I'm looking at buying the stock here, but buying the stock here I have to wait a period before I can earn dividends, okay? So I don't know what just happened. Take a picture or something. Okay. So because this is the information today, I've updated the timeline to include that information. And so because it's a quarterly dividend, I need the quarterly rate for valuation, and that's it. Now looking at this in terms of our formula, remember, so the first step is convert everything to quarters, right? Because that's the timing of payments, and there are payments in this exercise. All right, let me see the volume situation. I set something. Is that better? Can you hear me? Testing, testing. I'm trying to block out the extra noise, but I don't want to block my voice, of course. So how's that? Any better? Okay. All right, so that's the timeline. That's the first step. The second step, oh, we didn't calculate it yet, but you need to find it, and it's solved for down below. So you draw the timeline and you apply the formula focusing on where it fits. So it looks like this is the first payment, and then there's growth, and then it grows indefinitely at 1%. So in that case, this portion here, I'm going to move this away. This statement needs to be clear. So you'll see here one period before the first one, and then growth kicks in after the first one. I want to value PV1. Read it out again, a little bit lower. So from here on, this would be PV1. But I can't forget this term as well, because I'm also, if I'm purchasing at time now, I'm going to receive this dividend and then all the extras, all the others. So I need to do a couple of things. I need to get the value of the perpetuity, so that's 125 over R minus G or I minus G. So that's going to be the quarterly rate minus the growth rate, and that's PV1. So I will call that step 2. Where you apply the formulas where they are on the timeline. And then step 3 is put it all together. That means you have to put together this amount at time 0 and this amount at time 0, because you've collapsed all these cash flows into this term, the PV1. So you need this plus this. So you need to discount those amounts back to 0, and that's it. How's that? Good morning. So the details, the calculations are below. Okay, so what I've done then is I found, so the question is how, so this is the actual question here, how much should its stock price increase? So what you need is to compare your result of the new price with the old price. So I've just found the new one. And you have to compare it to the old one. The old one is just the perpetuity of 1.25 forever. Okay, I'll just turn it up. That's why. This thing. How's that? Much better. I was not on the microphone. It's this constant battle I have with my new computer that it goes to my internal speakers, and my computer is quite far away. I have a microphone that I speak into that's right near my face. That's why I have to turn down the switches. Otherwise it sounds like I'm screaming. So how's that? All right, there you go. I don't know, it just resets all the time. I have to always check. I have to always check that it's using the sound is the sound input is my microphone. All right. So that's what we're doing. So the new stock price minus the old stock price would be the change in price. So if you had trouble listening, hearing this, basically it's here anyways. You just have to read through what I've done to find the change in price. Of $8.80. Is that all right, Tanya? All the numbers are here. I don't really want to recalculate them. Okay, any other questions? I'm going to get on to the new material. I'm gonna get myself a copy. Oh, it's okay. I'll just do this. Use this one. Okay, so we're going to start here. So in each of the units so far, each of the modules, I've provided a summary page or a, like, the tips of how, like the most important highlights of the module. So I've done the same here. So that would be 3.2. So let's begin with the notes, and then you can, at the end, after class or in your review, work with the summary sheet and then all the exercises I gave you to practice. And again, I gave most of the solutions except for the last one. I didn't give you solutions. So then we'll have something to work on next week together. Well, you should be able to work on that on your own, and then we'll discuss it next week. Oh, Vanessa says she wants to see 13. Let me see. What should I do? Let me see what 13 is like. Oh, it's one of the long ones. All right, what I'll do about 13, because I'm not going to go step by step, look at it and we'll begin next class with 13, okay, Vanessa? So I'm just going to make a note here. If you still need it, I'll do the review next class. First thing. Okay, because you need to sit and go through it, read it. You can also contact me if you're confused about what I did. Okay, so let's see. We're going to start this topic. And it's going to look familiar because I'm going to begin with something we've already discussed, and that is the net present value rule. The net present value rule is used to determine if an investment is profitable or potentially profitable, given all the assumptions inherent in valuing the project. And so we're going to begin with net present value rule for valuation of projects. But then I'm going to go into some alternative investment techniques. Okay, so this unit is called Techniques for the Valuation of Alternative Capital Investment Projects. Actually, I could call it alternative techniques for the valuation of alternative capital investment projects. So what we're going to do is determine not just if we should pursue a project because it's profitable, we are also going to compare projects. So I'm going to teach you how to do that. Now, the difference between doing that, what we were doing before, and just evaluating one project on its own merit is known as an independent project analysis. But when you compare projects and you can only pick one, that's called mutually exclusive project analysis. When you have financing, so your firm or yourself has enough capital, so enough access to funds that you can invest in more than one project, I'll refer to that kind of analysis as a capital rationing. So this is, you have capital available to conduct several projects, but you're limited. You don't have unlimited funds, okay? Which is very realistic. All right, so before I go into this is kind of meaningless until I show you an example. Let's start with the net present value as a review and as an introduction as well to this topic. So the net present value rule, if you remember, I need to identify the initial investment and the potential future cash flows. These will accrue if I adopt the project. So because I understand time value of money, I will need to determine the present value of those future cash flows and combine it with, offset it with the cost, the initial cost or initial investment. So to do this, and so far it's been pretty easy because I just give you the values and then you make your calculation, right? Well, in this course, you are actually going to be given information to derive the values for calculating NPV yourself. Like all the information, the background, you have to choose which future cash flows should be part of your analysis and which shouldn't. And you have to estimate the initial cost given information. You have to estimate, like I mentioned, the future cash flows, how large they are, and when they will arise. We usually assume that cash flows are at the end of the period. That's another, that has an effect on the estimate, right? Because cash flows don't always just come at the end of a period. They could come at any point in the period. But anyway, we make that assumption, and then we also use a discount rate that's really just an estimate. So all these estimations that go into creating the cash flows that you use to calculate the NPV, all of these are estimates, and so your estimate of NPV or your calculation of NPV is only as good as your estimates are. So for this unit, I'm going to give you cash flows and you're going to practice valuing the cash flows given the different techniques. But then in the next one, in the capital budgeting module, you're actually going to derive these future cash flows. And after that, in the following unit, you're actually going to estimate the discount rate. So we're going to do all of this from scratch, all right? I'm going to teach you how to make assumptions and how to use those assumptions. Okay, so how do we use the NPV rule? Well, if we have a project and we're given the cash flows and the discount rate, then we can evaluate that project, calculate the NPV, and if the NPV is positive, we consider this a profitable project. It's not zero, and we will pursue the project, we'll accept it. If the project is undergoing independent project analysis, so we're just checking, is it worth it? So this comment here is that for NPV, we have a minimum acceptance criteria. So if for NPV we use 0, anything bigger than 0, any project with NPV greater than 0 should be pursued. Somebody else might have a different, minimum, but the standard, the convention is to use NPV just positive. If instead of just valuing a project on its own merit, you have several projects and you can pick, or you're told you should pick one because you don't have the resources for more than one, what you need to do is calculate the NPV of each project and pursue that project with the highest NPV. So this is known as ranking. Okay, you put them in order and pick the one with the highest NPV. So that's how we use the rule. And as an example, and I sent you several exercises you can practice this week. As an example and as a reminder how to use your calculator, this is the timeline for a project. I've demonstrated what my estimates of future revenues will be and also the future expenses, and I've put them at the end of each period. So I've calculated by the end of period 1, there should be a positive $500 cash flow. And by end of period 2, $700. And then by end of period 3, there's going to be anticipated loss of $500. And then end of period 4, there is a cash flow anticipated of net, $1,200. Now you can think these are low values or low numbers for this project. So think of these as, if you think about these as thousands of dollars, then these really represent millions. Okay, so you can think this is how you'd work with even, you can imagine this actually being a practical exercise. So you take these future cash flows, you calculate the present value, and then you you check if that's enough to offset your initial investment. The initial investment for this project was $1,100. So I need to put that together, and I find I have a positive NPV, and so because of that, I would accept the project. Now, how do we calculate this? Or okay, first of all, in this class, in the test situation, you don't have to write this timeline like that. As long as you show me this, I'm happy. So you show me the formula with the values in the formula, and then you can show me your final answer. Now, how do we get this answer? We use the cash flow keys on our calculator. Now, on the next page, I left some space where you can make a note about which cash flows, which keys you use. So why don't you take a moment to use your calculator to get these values, to enter these values and get 377.02. Let's see if I can do it. Let me check something. Oops. Yeah, I'm sort of skipping over pages, but I'll go back. I will go back, don't worry. All right, so let's enter these into our calculator. I'm going to use the BA2 Plus as promised. Okay, I have something on the screen. I can clear that. And I want to use my CF key. So I'm going to press CF. There's something there. So I need to clear that second. Clear work. Now I'm ready to go. The first value is the 1,100. Oops, use this arrow when you make a mistake. So that's a negative cash flow, which I'm going to enter, and then scroll down. The first cash flow then, because that was the initial cash flow, is 500. So I'm going to enter that, and it's going to ask me again, frequency. There's only one of those, so I leave it like that. I scroll down. Now I enter 700, enter down, and then down again, and then 500. Now this one is a negative. Enter down, down, and then 1,200. Oops. Enter down, down, and I'm done. I can check what I've entered. Let's see. So it was first the initial cash flow or initial outlay, and then the future cash flow is 500, 700, negative 500, and 1,200. So this is just a reminder of how to do this. And now I ask for the NPV. To get the NPV, I hit NPV. That's not the final answer, right? I have to put the interest rate, and you're told to use an interest rate of, or required rate of return of 10%. So I put 10, enter down, and then I compute. And there you go. So I've done that once. Now you're not allowed to forget. Yeah, so this is a mixed cash flows problem. If you remember, go back and read your notes. This is a mixed cash flows problem. But we have the key, the NPV key, on our calculator to compute the NPV. So this is the initial investment offset by the present value of future cash flows, like it says here. So, given that it's positive, we should accept this project on its own merit. This is an example of NPV, and it's also an example of independent project analysis. I'm just deciding if it's worth it. Any questions? So now let me backtrack a bit. That was NPV. Oh yeah, I just have the information there. So what I wanted to say to you, so we're going to review different techniques, and we're going to hone our skills in the art of valuation. Okay, A stands for the amount of each cash flow, the risk-adjusted required rate of return is this part. So we're gonna learn about how to calculate that when it's not given in module 5. We're still on number 3, and the timing of cash flows. Now we've reviewed the net present value rule, but there are other types of rules. Back on the first page. Following the same, I have the definitions of independent project analysis, when you're just deciding to accept or reject a project. And in particular, picking one project doesn't affect the decision to pick another project. So you could take, if I ask you to conduct independent project analysis, then you can take more than one project. There's no budgeting limitations. If I tell you there are limitations, you can only afford resources for one project, then you're doing a mutually exclusive project analysis. Where you have to rank your alternatives and pick the best one, depending on the kind of metric you're using. Okay, so we're going to learn basically different measures to evaluate projects. Well, we're going to use the same measure across projects and then compare them. And then we're going to end off with a discussion of the scenario where you can take more than one project, but you can't afford all of them. So what to do. And so we're going to review these. Most of the exercises are going to be conducted with independent projects, and then I'll talk about these analyses. All right. So that brings us from NPV. We're going to talk about a technique that's really just a rule of thumb. If you're looking at investing in a project, you're going to wonder right off at the start of considering the project, when will I get my money back? When will I recover my costs? So we call this they call this project analysis, this type of rule, the payback period rule. The payback period is a measure of the number of years to recover costs of the project. So it's a different way to measure the project, the value of the project. If you have several projects and you just have to analyze if they're worth it, then you're going to say, well, I want this project to pay back in a maximum of so many years or so many periods. So I want my money back. If I'm going to be an investor in someone's project, I'm going to stipulate at the beginning, I need to recover my costs in 2 years, for example. It doesn't have to be 2 years. It could be maybe they're patient and they can wait 5 years. So investments in pharmaceutical company can take several years to return revenues or to recover costs. Alternatively, if you have many projects and you have to pick among them, just pick one, you're going to probably, depending on what management stipulates, you're going to pick the one that pays back sooner, right? So I want to do an exercise to demonstrate how this works and then talk about how this differs from net present value rule. Now, since they're different, if they're really different, then what are the differences and which one's better in different, in various circumstances. Okay. So here's an example. So I'm just going to look at these sets of cash flows first. So if you look at these, the initial outlay is $1,000. The cost of capital or your required rate of return for the project is 10%. What it means is if you decide not to pursue this project, you're looking for a project that returns 10% on every dollar invested, okay? So this is what we're going to use as our required rate of return. If we're not investing here, then we're going to invest in the stock market, or we're going to invest in somebody else's project to earn 10%. If we can find a mutual fund that gives us that kind of return, then we'd invest in that. But so we're comparing this project against this required rate of return, this opportunity cost. Okay, so let's see. This project costs $1,000. Now, just looking at these cash flows here, it looks like, okay, in the first year, it's $200. We anticipate revenues of $200. Then by the end of the second year, it's $400. So that's $600 recovered. And then between the second and third, third year, you make your $1,000 back. So that is an example of the payback period. I'm not being very precise, but just demonstrating to you what the payback period is. So it's in between second and third. Now I can be more precise, and I'm going to teach you how to be more precise, but at the beginning I want to ask you, what do you see as a problem with doing this? What's the problem with just doing it like that? So this is something, I could come up with some estimates of revenues and expenses, and then this is like the net that I anticipate, and then I think this is my best guess of what future cash flows look like. And just looking at this without a calculator any more than I've already done, I just say, well, it looks like between the second and the third year the project will pay back. So what's wrong with that? What do you see as potentially wrong with that analysis? Okay, so Juan has pointed out that I end up just focused on this period between the second and the third year when it pays back. And if I'm working to promote this project and someone else is making the decision if it's profitable or worth it, they're just going to want to know, if they're going to use the payback period rule, they just want to know this number. They want to know at what point in the second year does it pay back. And they already have predetermined whether they're going to accept a project that pays back in 2 or 3 years. So they're really focused, hyper-focused on these cash flows, and they're ignoring the future ones, which in this case, it's not out of line with the others, but what if it was? What if it was huge? What if it was in the millions? Relative to the other cash flows, maybe some managers or executive decision makers would want to consider that, and you'd want to demonstrate that if you were trying to support this project or have this project adopted. So that's a problem for sure. And I've listed some of the issues. What else is a problem with doing it like this? So that problem is like ignores future cash flows beyond the recovery period. What's another problem? Or what's all this other business going on here on this page? if I analyze payback period like this, as I've done, I've completely ignored time value of money. So I'll take issue with this one. I can fix that. I can correct for the fact that it ignores time value of money. And I can incorporate this sort of analysis, discounted payback. I can use a calculator or Excel and discount the cash flows. So this is just discounting 201 period. And 331 is discounting 400 2 periods. You following me? Okay, so I prepared now a table of the discounted cash flow. So I'm going to focus for the next part of the discussion on the discounted payback period rule. And that still leaves this issue about ignoring future cash flows, but let's look how we deal with this. So what I'm going to do here is this is a column of the present value of future cash flows, okay? So this one is discounted 1 period to get 182. This one is discounted 2 periods to get 331. This one 3 periods to get 527, and so on. And now I want to replicate what I did before by summing these cash flows. So this is the accumulated. So, I mean, I could make the column over here as well. So I'm just going to reproduce this here. So this would be, in the first year, it's 182. By the second year, it accumulates to 513. And now I'm going to add this in the third year, so it becomes 1,000. So this is cumulative as I go through time. Finally, all right, so it looks like, you see, we would have recovered, and I've accounted for the time value of money. We will have recovered $1,000 by the end of the third period, right? So somewhere in between here and here still is the $1,000. So how do I figure out exactly where? And why would I want to do that? Well, maybe other projects are going to come along and I want to compare them, which one pays back sooner. It would be important to get a precise measure. Let me use this sum. So how would I find out where? So I'm going to teach you this method of interpolation. I think that's what you would call it. But anyway, this is a method to calculate more precisely where, how many years from now. So to calculate the discounted payback period, that's what that stands for, we know that it's got to until at least 2 years. So we're going to put a 2 here. And then what we're going to take is the remainder of what's recovered in the third year. So from 513, that we've already recovered, that leaves 47 that we need for the third year. So we got to move into the third year as much as $487 takes us. If we smooth that out evenly over the year, notice that it was $526. So what we say is, well, over that third year, we need 487 out of 526. So that portion of the year is what we need. So it's almost 3 years that we need to recover our costs. But precisely, it's 2.93 years if you make the calculation. So some students, they have a little bit of problems with this because they don't sit with it to practice. And I gave you some exercises to practice making this calculation. It's rather straightforward. I've put it in years here. So you go until the closest year, and then you still have $487 to recover. So that's almost half. So you use the remainder up to the third year, what's left to recover in the third year, and then the total amount, well, in present value terms, that's recovered in the third year, and you calculate precisely at what point you will have recovered your costs. So practice with that, making that calculation. Okay, it's not hard. You can put that on a formula sheet and on your pages where you study from. You should be preparing using my summary pages and the formula sheets I gave you at the outset to build your study tool. Okay. Okay, so what next? What's wrong with this? So we've adjusted for the discounting issue, and I've shown you how to do that and how to get a precise measure of time of, well, given the assumptions and the cash flows that you've used, a measure of the time at which you've recovered the costs. It remains, however, that there are two problems. One is that we did not consider cash flows after the recovery period. So we haven't considered all the cash flows. And this could be potentially detrimental, okay? What if that fourth year, there's a huge loss that you completely ignored? What if in the future there's a huge windfall? So in this case, where in this project, this is almost 3 years. Let's say we're told that we should only accept projects that pay back in 2.5 years. Then this project would have been rejected, you see. But that ignores completely what happens in the fourth year. What if in the fourth year you're expecting $1 million? You haven't even used that figure in your calculations. Or what if there's a loss of $1 million? Someone sues you. Or you anticipate there's going to be some sort of legal challenge, or some sort of, if you're conducting an environmental project, then regulators are going to review the project, and you anticipate that you have to deal with environmental damage done in the wake of conducting your oil rig drilling or something like that. Okay, so there's anticipated loss in the fourth year. You completely ignored that. Well, I'll just leave it like that so it's not messy. So what's the deal? Well, let's think of it this way. NPV would use all the values, right? So we really like NPV But the discounted payback period gives us additional information. So you could use both, all right? You should use both. So summarizing, what are the disadvantages? That 2-year period, or the cutoff maximum number of years or number of periods to recover costs is rather arbitrary, because without looking at all the cash flows, what are they basing that on? Right? So NPV would use all the cash flows, and then basing your decision solely on the discounted payback period rule is not advisable. But with the NPV as well, then you also include the missing information about what's going to happen in the future. So payback period is should be used together with the net present value rule, in my opinion, and usually is. So just to say, so far then, what we've talked about are the 2 rules which NPV gives you a dollar amount, and the discounted payback period gives you a time. I'm also going to include the payback period because that's a convention also that's used. It's a very quick way to communicate the viability of a project, how worthwhile it is. So these are different metrics that can be used in tandem. Right, thank you for your comments. Okay, I'm just reading the comments. All right, so now we arrive at the 3rd rule. We're going to spend some time with this. So the NPV gives you a dollar figure. The payback period rules give you time. What about a percentage? The internal rate of return gives you a measure that's also easy to communicate, and that's why it's very popular. It's the percentage. It's a measure of the return on investment. So let's see how we do that. Okay, so I spent some time on this page 10, and I wrote down, it's more of a summary. I'd rather get into the internal rate of return and then again come back here. Okay, so we'll come back to this page. Let me just say a few things at the outset. What is the internal rate of return? The internal rate of return is mathematically, it's the discount rate that gives you the break-even NPV, or NPV equals 0. So we interpret it as the return on the project, if it's an investment type project. And what we're doing is assuming a reinvestment, making a reinvestment assumption that in the interpretation we're saying that this is the return if we were to calculate all future cash flows at that rate. So now that I've confused you, let's just look at the numbers. So here's an example. If you've never seen this before, this is an example. I've given you the cash flows. So you're going to see this sort of set up in these problems. This is the initial outlay. So $2,200 is the investment. So this could be to buy some equipment. You can again think of these as these are millions of dollars because, well, it's 2,200 thousands, which is really 2 million. So let's say we purchased a building and then we want to operate our ticket sales company, right? So we sell tickets. We're like a ticket master. What do you call it now? Anyway, ticket sales company. So we anticipate by the end of the first year, we'll have cash flows in the order of 800 thousands, or I'll just refer to it as 800. And then 900 by the end of the second, 500 by the end of the third, and then this windfall at the end of the fourth. We refer to this as an investment project because we invest and then, so negative initial cash flow and then positive returns. Calculated at anticipating revenues and expenses, this is the net. All right, so set up your NPV, set it to 0, and use this notation, IRR. This is the discount rate that I want to solve for. So I want to find the discount rate at which the NPV breaks even. NPV is 0. So mathematically, this is hard to solve, right? I can't do this. I cannot isolate, so you don't have an analytical solution of this problem. You cannot isolate IRR on one side. All right, so the solution here is an iterative solution. Your calculator has, it uses the values that you enter, and it's putting values of the discount rate in and checking how close it is to 0. Is it positive or negative? And then based on the result of this NPV, it chooses the next value to put in as the discount rate. Okay, so it conducts this iterative process. That's really one of the main reasons we're using the finance calculator, because it's the fastest way to do this. I don't want to bog you down in solving this mathematically or analytically. I just want you to get the answer and make the interpretation. Another way to see that is if you put this amount on this side, you're just trying to find the discount rate that makes the future cash flows equal to the initial investment. So notice as values of IRR are increased, what happens? Well, I'll go this way. What happens to the NPV? So if this goes higher and higher, I guess it's easier to see over here. So what happens to this side as the internal rate of return goes higher? What happens to this the right-hand side of the equation? The right-hand side of the equation, because the value in the IRR is in the denominator, each term will go lower or down, making the sum of the terms decrease. So as the internal rate of return increases, right, this is your ability to offset the initial investment decreases. So you can see it in the second term or even in this one, because this one, if this goes down as the IRR goes up, so picking higher and higher discount rates are going to make this lower and lower, So the NPV goes lower and lower. Okay. All right, so we don't have to actually be picking, we don't have to pick the internal rate of return, but we have to realize the relationship between the NPV and the IRR. And when we picture that, what we get is what's known as the NPV profile. So, as daunting as this seems, let's calculate the IRR using the calculator, and then I'll show you how we go about solving this without a calculator. Well, we're still gonna need a calculator, but we're gonna work on. I'm gonna illustrate, and you're going to have to do it as well. Illustrate the operations of the calculator. So just to enter this in our calculators as it is, enter these values as though you're going to compute the NPV. So this is your initial outlay, these are your cash flows, and then the difference is that we're going to ask for a different figure. We're going to ask for the internal rate of return. Okay, let me get to your questions in a minute. Let's enter this into our calculator. All right, so let me clear this. I hit CF and then second clear work, right? Because it's a worksheet. And then I start entering 2200 with a negative. Enter. That's my initial outlay, initial investment. Then I go down and enter the cash flows. 800, enter, down, down, because there's only one of those. 900, enter, down, down. 500, enter, down, down. And 1600, 1600, enter, down, down. All right, so I'll let you do that. And you see now on your calculator, there is, beside NPV, the IRR, the internal rate of return. So you can, that's an alternative, you can ask for that. So ask your calculator for it. Now, all that showed up was 0 because I have to tell the calculator to iterate, to compute. And there you go. So try that, see if you can get that. Let me know. So if you're paying attention, it seems like I'm computing the net present value, but there was a step that I missed, right? What was the step that I missed? I did not have to enter an interest rate. Of course not, because what I'm interested in is finding the interest rate. I'm trying to compute the interest rate that sets the NPV to 0. Okay, people got it? Anyone have questions about getting it? Now we're going to interpret it, okay? And I'll do a better job of explaining what I was talking about before. Very good. Okay, so most you guys are getting it. Okay, so we find the IRR is 23.6%. 23.3%. So in a test type situation, what I expect you to do is to either write one of these out, this one or the other one here, and then just give me your answer. Unless I ask you for the NPV profile. If I ask you for the NPV profile, you have to do this manually. Well, not exactly manually because you are going to use your calculator, but finding the internal rate of return, you're going to use the NPV to help you. And what we're going to do is pick values of the internal rate of return and calculate the NPV until we get as close to zero as we can, or as we need to. So what am I talking about? We're going to make the NPV profile on this page. Any questions about using your calculator so far? Uh-oh. The NPV profile is, you set it up so you have a discount rate here. I'm going to make this bigger. That's my friendly construction upstairs, if you can hear it. So I'm going to make a column for the discount rate that's used in the valuation and the NPV. And my goal again is to try and get NPV of 0. So usually in this class, I will tell you how which discount rates to pick, but in reality, if you ever use this in the future, there's nobody to tell you. So I'm going to show you, I'm going to demonstrate ways of doing this. So I'm just going to make, this one's going to be simple because it's the first one. And what I'm going to do is use a discount rate of 0. I'm going to go by, let's see what I did in the notes, so I went by 5s. So I'm going to use 5%, 10%, 15%, 20%, and then 25% and 30%. Now we just figured out that the internal rate of return is here. It turns out the IRR is 23.3%, so it's in here, in this interval. So what we're going to do is use the NPV formula and change the interest rate to calculate and recalculate the NPV. So we're going to start with 0. Okay, now we don't have to plug it in here. We're going to use the calculator to do this. So I already have the numbers entered. All I have to do is now hit NPV. Now obviously NPV will be 0 because that's what the IRR is. So that's going to be 0. But now I'm going to change the interest rate. I'm going to make, well, not to confuse you, but I'm going to make the interest rate 0. And now I'm going to ask to compute the NPV. What did I do wrong? Oh, right. So I put I as 0. So I said I 0, enter, then I have to go down, arrow down. Now compute NPV. So the NPV so the net present value when the discount rate is 0 is 1,600. So let's go back and see that. So that goes on to my chart as this amount. All right, so what I did was tell the calculator put a 0 here, and then you can see it's going to just calculate 2,200 negative plus 800 plus 900 plus 500 plus, because these are just ones on the bottom. Okay. All right, so that was not 0, right? That was not 0. I'm trying to find where the NPV is 0, where NPV is just a 0. So that didn't work. So let's go to a higher number, because this is a higher discount rate will bring down this term. I want to bring down the NPV, right? Because it's too high. It needs to be 0. So let's put in this number, 5%. Let's do that together. So let's go back to arrow up, and let's put 5 in there. Enter, and arrow down. That's not the answer, right? We have to recompute, compute. So now it's gone down to 1,126.47. Okay, I use a decimal place. It's 47. Okay, so it's going down. Let's keep going. Let's use a higher one. If I use a higher discount rate, then this NPV will go down even more. I'm still trying to go to 0, right? So let's put a higher number in there. Let's hit enter. No, what do I want to do? Arrow down. No, arrow up. 10, enter. So I've entered a new discount rate, and then I ask for the NPV, compute the new one, 739.55. So it keeps going down. Let's go even higher. Let's keep on going. So let's use 15. So putting 15 in there. You guys should be practicing this, because it seems it'll make more sense when you do it. So now we're going to enter arrow back to the I. So that was 10. Now we're going to go to 15. Enter, down, compute, 419.74. So let's put that in here. 419. We're almost there, right? Keep going. 20. Let's put 20 in here and recompute NPV. It's 152.62. It's going down, down, down. And then at 25, I saw your answer, Paula. Let's see. And I'll answer it in a second. So now we're going to put in 25, because we haven't hit 0 yet. So let's put 25 down and recompute. Aha, 72.64. Negative. So I know, because it's a monotonous or monotonous, what was it? Hold on, let me get that number before. 72.64. Because the function, it's a function, and it's steadily going down, it crosses in here somewhere, it hits NPV equals 0 for some discount rate. And then I use my at the beginning I used my calculator to get it, But let's say you didn't have the calculator. What should you do? You should take this area in here and expand it some more. So you could say between 20 and 25, I can try 21, 22, 23, 24, and 25, expanding this to see where does it get closest to 0. Okay, so this is how you would do it without IRR on your calculator. So some calculators don't have this function. But and you're going to see it, I'm going to show you when you have to do it. Even though you have IRR on your calculator, you have to use this approach. So you need to learn this approach, even if you do have IRR in your calculator. But this is what the calculator will be doing, and this is what you could do manually to estimate. So putting in 20 is 152, right? So this is 152.62. And then all the way to 25 is 72.64 and negative. So if you put in 21, it's still positive, 104.52. Okay. It's going to be positive here, and then it's going to go negative. So you're going to know it's between 23 and 24. Let's just get the values. So 22. Enter, down, recompute, still positive, 58. So NPV is 58. And now for 23, I'm going to put 23 into interest, enter, down, recompute. Still positive, 13, right? 1302. Oh, I didn't put the decimals there, but okay. And then on 24, you're going to see that it goes to negative. No, that's not on to. 24, enter, down, and compute. Now it's negative 30.51. So what does that do? That tells you that it must be in here between 23 and 24. So in this way, the calculator just looks for the sign and approaches. Once it's overstepped, it goes back and iterates between here. So it's picking values and plugging it into the NPV formula to find out the internal rate of return. Good. So you see. So as much as you have a very powerful calculator to do this for you, you also need to know how to do what I'm doing right now. This is known as the NPV profile. Now some people can do this and not ask any questions about what the heck is going on, and others need more explanation. So I'm going to illustrate now what this looks like, and maybe it'll help. Okay, let's see the drawing. So here is the NPV profile, and I'm going to talk about the interpretation in one instant, but I'm going to use this graph to talk about it. So here we have an illustration, a graph of the chart. This is the formula for NPV, putting different values of the discount rate in. So this is a continuous model of what we just did, because we just picked values, right? But this is if you did it for every single value in here would make it's a smooth curve. So that function, it is a function, and it crosses when NPV is 0, right? We calculated this, if you remember this number. When NPV is 0, we got 1,600. That was the first value on our profile. And then as we added higher and higher values, the NPV fell because it discounts the future cash flows a lot more. And so the present value is lower. So it goes down, down, down until it crosses. What is it crossing again? This is where NPV is 0. So this is NPV of 0, right? Because NPV is on this axis. So this was where it hit 1,600 at discount rate of 0. And where it hits 0 is called the internal rate of return. And we computed that it's 23.3. Now, this drawing helps with the interpretation. If this is the net present value, where as an investor or as a analyst looking at the potential profitability of this project, where do you want to be? Do you want to be on this part of the curve? Do you want to be over here? Where do you want to be? Well, the Npv rule says you want to be where NPV is positive. So you want to be here. So all of these discount rates here, so remember, what is the discount rate? This is set by management. They say, or if you're running a company, you say, look, if I don't invest in my own company, I want a return of the required rate of return of 10% or 8%. In this case, I haven't stipulated what it needs to be. I haven't said it needs to be, any particular number. What I'm trying to figure out is what it can't be. So what I found is the threshold. At this point, if my project required 25% rate of return, then my project would have a negative NPV and I should reject the project. This is telling me where the discount rate, what the discount rate limits are. Okay, so project, as long as the project discount rate, as long as you don't require any more than 23.3, you should accept the project. All these discount rates are fine. So we say accept the project as long as the internal rate of return is bigger than is required. So as long as you're here, in other words. So this is bigger than all of these below it. So as an application, of this, if the required rate of return was 15%, then we should accept the project. If the required rate is 25%, then our project, where we interpret the internal rate of return like a return on the project, the return on the project is about 23%. That doesn't exceed what's required. Okay, so we would reject the project. So internal rate of return is the one we computed. The required rate is one that management has in mind. Okay, so I've shown you what the calculations generates. They generate this curve known as the Npv profile. And you could draw it. I mean, with these values, you could smooth out, like you could make a graph, always remembering that the discount rate is here. And then NPV is here. And you could plot these values and know that they're all going down, sort of thing, okay? You could smooth it out. Like that. Okay, so you could actually plot that yourself. And I've shown you where it is and how you interpret. The main thing to realize is it divides it divides where you should be accepting the project and where you should be rejecting the project. Okay? Let me put that as a note. So you accept the project if your required rate of return is somewhere in here, and you would reject the project if it's down here. So as much as it seems like we've done something different, we really have just been using the NPV. The difference is that I'm not telling you exactly which one of these is the discount rate. I'm saying get them all, calculate all of them. Okay? Use all of them and then make a profile of the returns to the project, right? So as long as you notice the NPV is positive here, right? And these are all positive NPV. For any of these discount rates we would accept, but since the NPV is negative here, for any of these discount rates we would reject. All right, so if you don't get that, it's okay, we're going to keep practicing. Here's another one. All right, so the same idea. This is my initial investment, and then these are my cash flows. Now, this is same analysis, but different cash flows. What's the difference between this and what we just saw? What do you see as the difference? Okay, let's proceed as though, just like before. So here we have, I'm setting the NPV to 0 using these cash flows, the initial cash flow, and then these future cash flows. I can write it like this, or I can write it like this. And then I'm going to increase the discount rate, generate an NPV profile, and make a decision. here's my NPV profile. You guys can calculate, you guys can generate this on your own now that you know how to do it. So the difference here relative to what we did before, the first one, when we use a discount rate of 0, we had a positive value. These all appear to be negative values. And then they turn positive, and this tells us that the internal rate of return is somewhere in here. So iterating between 10 and 15%, we could find, and our calculator will find, 14.37%. Now we need to interpret that and be a bit careful. So what I want you to do is get this on your calculator. I'm going to flash the slides. So get the 14.3%, the internal rate of return, and then we'll talk about it. I'm going to get some water. I'll be right back.
Okay, I'm back. All right, so some of you have noted that it's different because they were negative cash flows, and how does that affect things? Okay, what is the story first? Okay, let's begin. So what's happening here? So initial outlay is $4,000. And usually it's a negative because you make an investment. But in this kind of a project, this is a finance project. So funds were acquired, whether it was some money was borrowed or some money was taken up front. So money was taken up front and then the project was delivered. Okay, so this could be, borrowed money, and then this is the result of revenues and expenses of paying the debt and operating the project and any revenues that would accrue. So you are net paying back your money, basically. This is seen as a financed project. Okay, so it's different from an investment project where you have initial cash flow was negative and the rest were positive. Now the initial cash flow is positive and the other one's negative. And the most important thing, that's important, but the most important thing is that they're all negative. They don't switch sign. That ensures that your NPV profile is a monotonous curve that always goes up. Okay, so it was a reverse positive initial cash flow, and then all the rest were negative. The point is that they all have to be negative. There can be no positives, or else you don't get this constant increase. So initially with this set of cash flows with a low discount rate, it turns out that the NPV is a negative. The higher the discount rate goes, the NPV becomes a positive. The important thing, as I mentioned, is that they all have to be negative to make this the NPV profile. That where they cross is where you find, or where it crosses NPV of 0 is where the IRR is. 14.37. And now, because things are flipped, the interpretation is flipped. But to have no fear, the graph is still telling you the answer. You want to operate where the NPV is positive, right? And that's over in this region. So we say as long as the discount rate, the required rate of return, exceeds the internal rate of return, you accept the project. So this is backwards of what we had before. And what we're doing is we're interpreting this discount rate, whereas before we interpreted it as like a return on investment or return to the project. Now, because things are in the reverse, we see it as the financing rate or the borrowing rate of the project. And we need it to be low. We need it to be below what's required for the project to be acceptable. So I'm going to leave with you the exercise of generating this NPV profile. So practice, as we did for the first one, entering and generating those. Let's just review the implications. This is a financed project. The required rate of return is the cost of financing. Thus, we accept the project as long as the required rate of return exceeds the internal rate of return. If it doesn't, we reject the project. And in summary, and this is also what I put in the summary sheet, the way we handle an investment project is we look for an internal rate of return that exceeds the required rate of return. But for a finance project, we don't want that to be the case for accepting the project. For an investment project, the first cash flow is a negative, and there's only one sign change that makes effectively the future cash flows all positive. In a finance project, it's the reverse. The first cash flow is positive, and the next ones are all negative with only one sign change. Any questions? So one is asking, why is it that the initial outlay is positive? I think I explained it. So this is kind of a finance project where you borrow the money and then, so you make the first one a positive and the rest, make the first one a positive and the rest negatives. So you should be able to use your calculator to compute this, and you should be able to also generate the NPV profile. And you should be able to do the interpretation. Okay, no questions about that? Everything is summarized here. So this is also in the summary sheet that I gave you. All right, so what we're going to deal with next, so far all we've done is evaluated independent projects using internal rate of return. We've done it for investment and finance projects. So what if there is another change in the cash flows? So let's say, so here I have the initial cash flow of, this is an investment type project, it looks like, and then a positive return by the end of the first year, positive cash flows by the end of the second, positive cash flows by the end of the third, but in the fourth year, there's a loss. There's a negative cash flow. How does this affect things? Well, in terms of the mathematics, that formula will not simply increase or decrease, it's going to curve up or curve down. And what it allows for, the possibility, let me do that again. There's a possibility that there's two places where it hits NPV of 0. So what do we do here now? So this is the NPV profile, and we still want to interpret this. We want to operate where the NPV is positive. we need to know where this happens, where it crosses, to know where to stop investing, or which discount rate prohibits or makes it unprofitable to invest. And that would be in this region, because these are all 0. Okay, so again, we use IRR to give us a range of discount rates that then we can take back, or we can consider more carefully as to whether we find the project acceptable or not, right? So different from calculating NPV, where you just get one discount rate. I have a whole bunch of them to look at. Problems with this approach, not problems, but limitations. What if this curve is always here? So let's say this was the NPV profile. Should you accept this project or reject this project? And when should you do that? One, are you clear about this? I've already explained here that for an investment project, the initial cash flow is negative and all the rest are positive. For a finance cash flow, the first one is positive and all the rest are negative. And now I'm talking about a mix of the two. If the first one's negative, the next few are positive, but then you have a negative, and what do you do? Well, it's the curve could be, the NPV profile could be like this or like this, and you have to figure out where it stops being profitable, or which discount rates would prohibit or restrict or tell you not to invest in the project. So my question was, what should I do here? So in this, if this was my NPV profile, at all points for any discount rate, the project has always a positive NPV. There is no internal rate of return for this project. It never crosses. But the fact that the NPV is always positive means accept the project, right? No matter what, it's profitable. As opposed to this case where the NPVs are always negative, no matter what the discount rate. There are no IRRs like here, but the difference is, in this case, the NPV tells you to reject the project. Okay, so you do need to generate the profile to understand what to do. So these are the extreme cases, and this is what we're going to focus on now. Okay, so how do we find multiple internal rates of return for an independent project? So here are some cash flows. What I've given you here are the cash flows. I think they're the same, right? Yeah. So these are the cash flows. These are different discount rates and their NPV. This is the NPV profile. And I see between here and here, there must be a place where NPV was 0. And then if you iterate, you get this precise number. And also between here and here, the NPV is 0. So if you were to graph this, it starts out as a negative and then it goes positive and then negative again. So it has this shape. So it's negative, positive, it goes like this. All right. So at some point it crosses. And we want to find those. So that would be, this first one would be 11.52, and then this one is 29.84. So what do we do? How do we make a decision? So here I've given you all the calculations, and now you tell me what should be the decision? So I expect you to generate this for yourself. Make sure you can make all these calculations with your calculator, that you understand what it looks like. Yeah, there's a delay for sure. It's not just the delay, it's like I'm not looking at the questions because I'm writing on a desk that's not facing the computer. The table's NPV is like a balance. Miguel, I'm not sure what you mean, but all right, so we would operate this project as long as NPV is positive. So as long as management has a required rate of return of 11.52% to about 30%, so 11 to 30, this project should be accepted. That's how you interpret that. So when you think that the stock market returns are about 11 to 12% on average, historically, it's not uncommon for management to set, a required rate of return above that 12%. So this is not unusual. So between, 11.5% and 30% is the required rate of return they should pursue the project. Beyond that, the NPV will be negative. And that is because if we made the formula, right, if we wrote the formula, it turns out this is weighing future cash flows it's making them less valuable. So future cash flows are less valuable. And it turns out that the negatives, the early on negative here, is not significantly offset by this $300 here because it's discounted so much. So this interplay of these cash flows, they're positive and negatives, and the strength of the discounting is what is summarized in the NPV going negative, okay? So early on, low discount rates mean that this 340, this negative 340 is very potent, and it really offsets any of the positives in between. So that's what makes the NPV be negative here. All right, so there's no strict rule when you have multiple internal rates of return. You have to graph it, and you have to find, or you have to know the pattern, at least get the NPV profile, know the pattern, and know what this means, interpreting the range of positive NPV, which is just in here, between 15 and 25. Or actually 11.5 and 29 to be more precise. Okay, this is profitable here. I should say between these two to be precise. Okay, so here's the graph, more detailed, and you guys can do this. I mean, you just have to make the NPV profile, draw a few points, and smooth out the curve, and you can get this. Again, this is where NPV is positive, so only in between discount rates between here and here, the firm would have to decide, well, what is our discount rate? If we don't require more than 30%, then we should take the project. But as long as we don't require less than 11.5. So strictly speaking, we don't call this kind of a project investment or finance project because it's not it's not like the kind of investment project that I described or the finance project.
But this does look like an investment because the first one's negative, but then the two sign changes. I won't call that an investment project. This generates multiple internal rates of return, and you have to generate the NPV profile to know the interpretation of your result. Okay, so let's try and get this in our calculator. Let's see what you get. Let's put these in. Let's put these in together. Yes, Juan, you can tell a story around these cash flows, right? You can tell different stories around these cash flows for sure. So you mentioned there's a development and death of a project. So it has some popularity early on. There's an investment anticipated, and then later on, the product dies or it loses popularity, or a competitor shows up on the scene. You can think about it like that, or you can, like I mentioned before, it could be that you anticipate that there's going to have to be some additional investment in the fourth year, or you need to restore some equipment. Something happens in the life of the project. Now, I haven't mentioned the horizon. Like, we're only using 4 years. So this is just a 4-year period, and then the project ends. We don't anticipate we're going to do this for more than 4 years. So maybe if this project involved some sort of development site, and then we had to restore the environmental conditions of the site, there might be an investment or some spending that has to take place here that we anticipate before we end the project. So there's different stories you can tell. So anyway, enter this into your calculator. Let's do that together and see what happens. So let's clear, cash flows. So I'm going to say second clear work and begin 260 negative, enter down, 250, enter down, and there's only one of those, so down, then 300, enter down, down, and 20, enter down, down, and 340 negative. And now I ask for IRR and compute. And I get this value, 11.52. So how could I possibly get the other value? So I get this value, fine. It turns out on the HP, if anyone has the HP calculator, on the HP you can actually get this value. To get this value so that it doesn't iterate just to this one every time, you need to overshoot the 29, putting a value like 30 into your storage. I think that's how it works. You put 30 into storage, and then your calculator starts iterating a little higher up, and then it finds this one. So the HP can find the second one. But the Texas Instrument, as far as I know, will give you one or might give you none, but usually I get one. I won't write that because I'll just say one. If it gives you absolutely none, let me know. It should give you at least one. So for the HP, let's see if I have that.
have the HP, right? Oops. See, now you're gonna watch me try and remember how to do this. First of all, I have to change okay, just a quick one with the HP. Let's see. 260. I have to remember how to do this. So if I do 260 negative, that's the initial one. I haven't used this in so long. 250. I don't think this is right because it's, where's my initial cash flow go? Oh, I probably shouldn't do this. Okay, so let's, anybody who's using the HP, what you need to do is, I believe, put into storage the value 30. And that will help in your iteration. I think that's how it works. Anyway, you can let me know if you use the HP and you want to know how to get the IRR. I just don't remember how to put in the first one. Why don't I? Anyway. Something like that. It's got the first and the second. But anyway, so if you are using the HP, let me know and I can figure that out, or you can find it online. All right, so that is that. We have still enough time, so work with that. I have some other ones for you. There's this one that we just did, then there's this one, so try this one on your own. And the interpretation, I leave you some space. This is the drawing, this is the result, and in this case, the IRR falls all the way over here. Now, mathematically, it gives you this value and this value, but usually a firm will not require a rate of return in the negatives. I just did this so mathematically we can identify where it crosses. Okay? So usually we'll just say this project should be accepted as long as the required rate of return is between 0 and 72. So it's probably going to be accepted. That's a really high required rate of return. So it's almost equivalent to having, you know, the whole curve above NPV. So this is all profitable here. And then the third exercise, you can try this one too. Fourth one. Okay, so you can generate the NPV on your own and you should get this graph. I know I'm going kind of fast, but you guys, it's just the same thing. So one last exercise I want to talk about. So this one will look like this, as I talked about at the beginning, and it shows you that the only profitable, you should only accept this project for a high or a low discount rate. And this has, again, to do with the cash flows, the way the cash flows go. There's no strict rule. You have to draw it, or you have to make the NPV profile and know the pattern and know that between if the discount rate is between 10 and 30, the project isn't profitable. Okay, So work on those. We can talk about that next week as well. Work on the exercises I gave you. That brings us here. And this was all mentioned back in the, so when I first introduced IRR, I had a page that I said I'd get back to. So let's get to this right now. So this is page 10. So the internal rate of return is the discount rate that sets NPV to 0, and it helps us to determine discount rates for which the project is acceptable. And then we can take that back and think about it and say, our other projects, we require this kind of return, such and such a return, and so we can compare this new project, and see, is it as good, or can we use the same discount rate for this project? Is it going to be acceptable? So the assumption in doing this is that we use the reinvestment assumption that the internal rate of return calculation assumes that all future cash flows are reinvested at the IRR. Well, basically, otherwise we couldn't write the formula that we do for calculating IRR. Putting NPV, calculating NPV with the IRR as the discount rate. All right, so independent projects, you accept as long as the return that you get, the internal rate of return you get, exceeds what's required for the project. So are you meeting the expectations? The disadvantages of just simply using this rule is that you're not distinguishing between investment and financing type projects, but I taught you how to deal with that. You reverse the interpretation because the pattern or the NPV profile is flipped. So the interpretation is flipped. It might be the case that IRR doesn't exist or there are multiple IRRs. We already dealt with that. I showed you how to generate an NPV profile to make a decision. So that leaves us with the problems with mutually exclusive investments, and that's what we're going to talk about next. So we've resolved most of the disadvantages. The advantages is it's a percentage return that's easy to understand and to communicate to people who are not so mathematically inclined. You tell them this is the return on the investment, or this is the cost of borrowing, or you show them the graph and you say, look, the project is not profitable to us because we're using a certain discount rate and it falls. That discount rate gives us an NPV profile or NPV of a negative amount. Okay, so we're going to now talk about mutually exclusive projects and how to evaluate them. So where you have many projects to choose from. So we'll start with 2. So here's an example of the challenge it presents, and I'm going to teach you how to deal with it in the next 15 minutes. Now, if you think that I've gone too fast, don't worry. You're going to take some time to work with this, and then we'll talk about it next week, okay? So don't just take this information and know that this is pretty much it. Like, I'm already on page 15. I'm practically done here. So this is just all you need to practice with and work on for this week. We're going to talk about the problems with the internal rate of return criteria when choosing between a mutually exclusive project. So here's an example of 2 projects, and I have to pick one. I offer you these investment opportunities as a student. I say, give me $1 now, and at 12 o'clock, I will give you back $1.50. Compare that to the second opportunity where you invest, give me $10 now, and at the end of the class, at 12 o'clock, or after the class, I will give you $11. We will recognize opportunity 1 is a lower budget project. Opportunity 2 is a higher budget project. How do we compare them? Are they comparable using the internal rate of return? So just to make some calculations to make this more interpretable for people who are still trying to learn, understand what I'm doing, I just said, okay, look, let's just use a discount rate of this amount. We'll say this is the opportunity cost of investing. I can calculate the NPV. Now, the NPV of each tells me what? It tells me that the dollar return is higher on opportunity 2. Of course, if I have $10, or sorry, if you have $10 to give me, I'll give you back your money and an extra $1. So you're getting a whole $1 back. I just discounted that for fun. So you're getting practically $1 back, right? And whereas in the first opportunity, you're only getting 50 cents. So in absolute terms, opportunity 2 is the better project, a better opportunity. But if you were to look for percentage returns, because the first one is a lower budget and 50 cents is a lot relative to the $1 invested, it looks like you have a 50% return on the project. Compared to the second one, where it's only 10% of your investment, and it looks like if you use the internal rate of return approach, it looks like you should choose number 1. So which is the right answer? And why? I'm asking you now. Does the NPV rule give you the right answer, or does the internal rate of return rule give you the right answer? You have to reconcile the difference. Okay, I see you guys. I'm reading your comments and you're getting it, some of you. Okay, so tell me what is going on. So which rule should I use? Should I choose 2 because of the NPV, or choose 1? So 2 or 1? You pick one, Miguel, and you put a question mark. It's funny. Okay, one says he wants more information. What do other people have to say? Okay, Miguel picks 1. Kind of tough, right? If you're facing the situation, like just think which one you would prefer and go from there. Use common sense. Never give up on your common sense because it's hard to defend. I always tell students that when you're writing a test and you're really confused, maybe because you haven't studied enough, or you didn't get into the depth of the topic, and you're asked a question that you're really just confused with, just go back to common sense. Because at least if a professor, instructor, or a friend asked you, why the heck would you pick that? You said, I use common sense. Otherwise, you have nothing to stand on. So Let's start with common sense and then we'll justify how we could get there. Okay, nobody else is guessing. Okay, so you should pick the one, and you should always, this is a rule, the NPV gives you the right answer, okay? The NPV rule, remember when we use the IRR, what did we do? When we had issues with the IRR, we always fell back and used the NPV rule, right? We're always using the NPV rule. You know, I'm using the NPV profile. I'm counting on the NPV. So why does the IRR break down? Well, it's using it like this is the problem. I can't compare high budget and low budget projects using the IRR. I need to compare them in a relative way. Like I have to combine them, and I'm going to teach you how to do that in a second. So I can't use the IRR for projects that have a scale problem. Okay, I can't do it this way. I have to use a new technique I'm going to teach you. Okay. Here's another. Oh, wait. Here's another problem known as the timing problem. This one I have already hinted at in the exercises we've done. Have a look at this project here. Compare it to this project. This one has a greater investment up front than this one. They're both investment projects, right? Because the first one is negative and the rest are positive. This one, you have to wait for a high cash flow return. And this one, right up front, you get the high cash flow return. Since the NPV calculation depends on the discount rate, this one will favor low discount rates, so 200 remains a strong number to offset the initial investment. And project B will favor higher discount rates because it doesn't really care about that. It really wants this value. These are the higher ones. So it doesn't mind higher discount rates that discount this and make this, diminish this value. They don't really care. So project B, the higher discount rate makes NPV greater. For project A, low discount rate. So this disparity, what's happening is, let me show you a graph if people like the graphs. So let's say if we had two projects and they were parallel, let's say this was A and this was B, this would say always pick A, right? If this was the NPV profile, because A is higher than B. The NPV is always higher than B. In this case, they intersect. And I have a drawing to show you that they intersect. Oh, sorry. The drawing is on top. No, where's my drawing? Oh, I guess it's here. It's on the bottom here. So the drawing, they actually cross over. This is project A, and this is project B. And they're not just parallel. You don't always see, in this case, B is always higher than A. So you would pick B. But in this case, A is sometimes higher with the higher NPV than B, and B is sometimes higher than A with a higher NPV until about here, right? Because this is where they're negative NPV. You wouldn't select either of them. So what do we do when they cross over? So that's the question. So this is known as the timing problem. So these are the two types of problems when you're evaluating two projects to pick one. You cannot simply calculate the IRRs because it'll give you the wrong answer. In this case, this one is telling you just to pick B because the IRR is higher. So this looks like these are both investment projects, and this would tell you choose B because it has a higher return. But that's not always the case. Because I didn't stipulate any discount rates, it's hard to know how to compare these. So the approach is, rather than do that, what I do is, and for both scale and timing problem, this is the remedy. All right, what you do is create what's called the incremental project. It combines the cash flows into one. Okay? Okay, so yeah, Miguel and Juan, we're still discussing. So in this project, so mutually exclusive means you can only pick one. So just to clarify, for mutually exclusive projects, we only can pick one. We can't do both. All right? So we have to pick one, but to pick one where we have a timing or a scale problem, we need to fix the problem by combining the cash flow. So how do we do that? We create an incremental project. We're going to create the project called A over B. So this project is, because we only get to pick one, this says pick A basically. So let's say we make a project called pick A. Pick A. And we write A over B or A minus B. So what I do is I subtract A by B. And I put the cash flows here. So if you do that, the first one, minus 350 minus negative 250 is like adding 250. So it's really minus 100. And the next one, it would be 50. Let me make sure I did that here. Okay. So the next one would be 50 minus 125 is minus 75. And the next one would be 0, and then 75, and then 150. So this is called the incremental project. And that is what I analyze. And in one set of cash flows, I get all the information I need. I will find the decision point here when I switch from picking A to picking B. Okay, so without doing this, all I would have if I didn't do this, all I would have with these two figures, and like I explained, sometimes A is better than B and sometimes B is better than A. So that's not good. But by putting them together, I'm going to find this, which is what I'm really interested in. When do I pick A and when do I pick B? This divides them. This is where I pick A, and then after this point is where I pick B, because it's above. Until, I guess, here, where it becomes negative. So I've done all these calculations here, and you find that if the discount rate is greater than 8%, you should pick project B, right? So let's see how I'm gonna summarize this. Let's say, okay, so let's make an example. So let's say the firm has a required rate of return of 10%. what should you do? Since the internal rate of return of picking A over B was 8, this is not high enough, right? So what we'd say is, if required rate of return was 10%, then, oops, the internal rate of return is not greater than the required rate of return. So 8% is not greater than 10%, so you would reject A over B. In other words, what's the other thing you do? If you reject A over B, then you do the opposite. Okay, so you reject A and you do B instead. So basically what that's saying, if it's 10%, that means we're here, and this is where B is better than A, and you should accept it. So it's almost time to end. This was a lot, but I'm basically finished. I have one more thing to discuss, and that is known as a profitability index, but you guys can have a look at that. Essentially, what we've done so far is talked about the NPV, which was in dollars, the payback period, which was in time, periods to pay back, the discounted payback period, which was also in time. We discussed the IRR, which was a percent, and now I'm going to leave with you, but I will pick it up next class, the profitability index, which is a ratio. It's a ratio way to look at your return on investment. So it takes the return over the investment as a fraction. Okay. And you guys can work with that, work with the materials I gave you, and everything before that. I promised I would start with the question number, was it 13? From the last review, 2.17 solutions, 2.17 solutions, next class. And then I will finish this material and answer some questions. We're also going to talk about capital rationing. So I'm pretty much done with this. And so I'll leave it with you. I'll stay online if you have any more questions. And maybe after next week, so next week will be the 19th. So then we can have, so that next Friday after that, so in 2 weeks, we'll have a Teams meeting and we'll all talk to each other in advance of the test on Saturday. All right? So I will send a new material for next week, which will be the new modules. What we're going to do next is capital budgeting. So we're actually going to sort out how we get these cash flows, anticipating future cash flows and investment cash flows. And next week, yeah. So this is done. In my opinion, we're pretty much done. I need about 20 minutes on this. So next week will be the capital budgeting material, which I can also finish in one class. And then in terms of capital budgeting, I'll explain it when we talk next week. So for the next test, the focus is going to be on module, I call this module 2, 3, and 4 because I didn't do 2 in the first. So the first test was really easy, right? You did well, but it was quite easy. So this one's going to have more material, but it's all doable. I'll make sure that what I asked you about the module 4, the capital budgeting, I'm going to give you. You're going to have enough time to prepare the case. That's going to involve preparing a case. But I'll give you nothing, not so elaborate. I'll leave that for the third test. So in terms of the chapters, if you want to read, let me see. I always have to check. One minute. So, no, not 7 and 8. We're into some 5 and 6. So for the next test, so chapters, for the next test would be, I guess, 3, 4, 5, and 6. I mean, we've done some of this already, but yeah, that would be the best if you want to read the text. And the modules, I'm referring to my notes that I send you. Okay, any more questions? So yeah, one was saying, would we call this, we would call this B over A, or you could write B minus A. Okay, so for people who need to go, get going, and I'll just stay on for a few more minutes to answer any questions here. Remembering that I'm available for office hours if you have questions you want me to solve, problems you want me to review. Maybe I'll even consider doing the one that I was asked to do because it looked really long, maybe in just a separate video. Let's see what I decide this week. But make sure you review all the things I give you. It's all examinable material. Okay, I'll check my messages, Juan. Okay, bye for now. Bye, everyone.